Before we begin, please be aware that the content in this video is for educational and informational purposes only. It should not be considered as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. Past performance is not indicative of future results. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. We are not liable for any losses or damages which may arise directly or indirectly from the use of or reliance on such information. You open a trading chart for the first time, and your brain just short-circuits. It's a chaotic mess of flashing red and green bars, moving up and down like a frantic heartbeat. You've heard the stories, you've seen the screenshots of people who seem to have cracked some secret code, but when you look at this screen all you see is noise. Feels overwhelming, intimidating, and honestly a little bit like gambling. You feel like you're one random click away from losing your hard-earned money. What if I told you that this chaos is an illusion? What if I told you that this screen isn't noise, it's a language? And every single one of those red and green bars is a word, combining to tell a story. It's the story of a fierce microscopic battle fought every second of every day between two massive armies, the buyers and the sellers. Most people who try trading just see the colors and make a guess. But the traders who find consistency, the ones who stick around, they don't guess. They've learned how to read this story. They see the plot twists, they understand the character motivations, and they can make highly educated projections about how the story is likely to end. This video series is your Rosetta Stone. This is your decoder ring for the language of the financial markets. My goal is simple. By the time you finish this series, you will no longer see a confusing chart. You will see a clear narrative. You will be able to look at any candlestick chart for any asset and understand the psychology, the emotion, and the power dynamics at play. This isn't about some magic indicator or a secret algorithm. This is about learning the foundational skill that underpins all technical analysis. It's like learning the alphabet before you try to read a novel. And it all starts by understanding a single humble candlestick. So why these little bars? Why not a simple line chart that just connects the dots of closing prices? The answer takes us back to 18th century Japan. A legendary rice merchant named Munehisa Homa became one of the most successful traders in history. While everyone else was just tracking the price, Homa realized something profound. The market is driven by human emotion. Fear, greed, hope, and uncertainty were the real forces moving the price of rice. He needed a way to visualize not just the price but the emotion behind the price. And so the Japanese candlestick was born. A line chart tells you where the price went. A candlestick chart tells you the story of how it got there. Shows you the fight. Let's dissect one. Think of a single candlestick as a summary of one round in a heavyweight boxing match. Let's say we're looking at a 1-hour chart. This one candle tells you the entire story of the fight between buyers and sellers over that specific hour. Every candle is built from 4 key pieces of information: the open, the high, the low, and the close. We call this OHLC. First, let's talk about the main, thick part of the candle. This is called the body. The body tells you the most important part of the story: who won the round. It represents the distance between where the price opened at the start of the hour and where it closed at the end of the hour. If the candle is green, it means the closing price was higher than the opening price. The buyers won. They took control from the sellers and pushed the price up with force. We call this a bullish candle because bulls thrust their horns upwards. Simple enough, right? Now, if the candle is red, it means the closing price was lower than the opening price. In this round, the sellers dominated. They wrestled control from the buyers and slammed the price down. This is a bearish candle because bears swipe their paws downwards. So, just by looking at the color of the body, you immediately know who had the upper hand in that period. Green means the bulls are in charge. Red means the bears are in charge. The longer the body, the more decisive the victory. A long green body is a knockout punch by the buyers. A long red body is a crushing blow from the sellers. But the story doesn't end there. Look closer. You'll often see thin lines sticking out from the top and bottom of the body. These are called wicks or shadows. The wicks tell you about the extremes of the fight. They show you the punches that were thrown but didn't necessarily decide the round. The very tip of the top wick represents the absolute highest price that was reached during that 1-hour period. And the very bottom of the lower wick represents the absolute lowest price. So let's put it all together. Imagine you see a green bullish candle. The bottom of the body is where the price opened. The top of the body is where it closed. We know the buyers won. But let's say it has a really long wick sticking out of the top. What does that tell us? It tells us that during that hour the buyers were so strong they pushed the price way up to that high point. But before the hour was over, the sellers fought back. They managed to push the price back down a bit before the final bell rang and the price closed. So even though the buyers won the round, the long upper wick tells us that the sellers are still in the fight. They showed some late resistance. Now let's flip it. Imagine a red bearish candle with a very long lower wick. What's the story here? The sellers were in control, pushing the price down from the open to the close. But that long lower wick tells us that at some point, they pushed the price all the way down to that low. And the buyers stepped in with incredible force, saying no, the price is not going any lower. They fought back and pushed the price all the way back up before the close. The sellers still won the round because the candle is red, but that long lower wick is a huge warning sign. It's a footprint in the sand, showing that a powerful army of buyers is lurking nearby, ready to defend that price level. You see how this is so much more powerful than a simple line? A line chart would just show you the closing price. It wouldn't tell you about that intense struggle that happened mid-hour. It wouldn't show you the attempted knockout by the sellers and the heroic defense by the buyers. The wicks reveal the hidden tension in the market. They show you where the price tried to go but was rejected. And these areas of rejection are incredibly important clues for what might happen next. Let's consider one more scenario. What if you see a candle with a very tiny little body, but very long wicks on both the top and the bottom? Think about the story. The price opened, then the buyers pushed it way up. Then the sellers took over and slammed it way down. Then the buyers pushed it back up again, and it ended up closing almost exactly where it started. This candle tells a story of extreme conflict and total indecision. It was an all-out war, but at the end of the hour, neither the bulls nor the bears could claim victory. It was a draw. A candle like this is called a doji, and it's a powerful signal of a potential change in momentum, a moment of equilibrium before the next big move. This is the art and science of reading a single candle. It's a snapshot of market psychology. The body tells you who won the battle. The wicks tell you how the battle was fought. But of course, a single word rarely tells the whole story. The true magic happens when you start stringing these words together to form sentences, paragraphs, and entire narratives. That's when you can start to identify recurring plot lines. Patterns like the engulfing pattern, the hammer, or the morning star. These are patterns that have been recognized for centuries, reflecting predictable shifts in human psychology from greed to fear and back again. Understanding the anatomy of a single candle is the absolute, non-negotiable first step. Everything else in technical analysis is built on this foundation. Before you can understand the patterns, before you can use indicators, before you can develop a strategy, you have to be able to look at a single candle and instantly understand the story it is telling you. Who is in control? Where was the pressure? Where was the indecision? This is the core skill. Master this and the chart will begin to speak to you. In the parts to come, we're going to build on this, moving from single candles to powerful 2 and 3 candle patterns. But for now, your mission is to internalize this language. Look at a chart not as a series of random bars, but as a chapter in a book, with each candle a new word driving the story forward. And just like learning any new language, you start with the basic vocabulary. You don't jump into writing novels. You learn the alphabet, then the words. In candlestick trading, our most fundamental words are the single candle patterns. These are the individual soldiers on the battlefield, and understanding their posture, their wounds, and their victories is the first step to reading the entire war. Let's start with the most decisive, unambiguous word in the entire candlestick lexicon, the Maribozu. The name sounds exotic, but its meaning is brutally simple. A Maribozu candle is pure body. No wicks. None. Not at the top, not at the bottom. A full, solid block of color. A green Maribozu means that from the very second the trading period opened, the buyers took control and never once let go. They pushed the price up and up and up until it closed at the absolute high of the session. It's a statement of overwhelming, undisputed bullish power. A red Maribozu is the exact opposite. Sellers were in complete command from open to close. They drove the price down relentlessly, closing at the absolute low. There was no fight, no hesitation. It was a massacre. When you see a Maribozu, you're seeing pure conviction. It's the market shouting, not whispering. It's an exclamation point telling you one side is in absolute control for that period. Now let's look at the polar opposite of that exclamation point. The question mark. This is the doji. A doji is a candle of pure, unadulterated indecision. Its defining characteristic is that the open and close price are either exactly the same or incredibly close to each other. This results in a body that's just a thin, flat line. It looks like a cross or a plus sign. Imagine a tug of war. The buyers pull, the sellers pull back. They fight all session long, pushing the price up, then down, then up again. But by the time the bell rings, they've ended up right back where they started. Nobody won. It's a perfect stalemate. This candle screams uncertainty. The market is pausing, taking a breath, and trying to figure out where to go next. And the doji has a few important variations that tell a more detailed story of that indecision. A long-legged doji has very long upper and lower wicks, showing that the session was extremely volatile. The battle was fierce, raging far and wide, but still ended in a draw. Then there are two others that are particularly fascinating: the dragonfly doji and the gravestone doji. A dragonfly doji has a long lower wick and no upper wick, with the open and close at the high of the session. It looks like a T. The story here is that sellers took control early, pushing the price way down. But then the buyers staged a massive comeback, pushing the price all the way back up to where it started. So while it's technically a candle of indecision because the open and close are the same, the story within the candle shows impressive buying strength. Conversely, a gravestone doji is an upside-down T. It has a long upper wick, and the open and close are at the low of the session. Here buyers pushed the price way up, but the sellers came in with overwhelming force and slammed it right back down. It's a sign of a failed rally within a single candle, and it tells a story of significant selling pressure. Seeing a gravestone doji after a long uptrend can be a serious warning sign. Closely related to the doji is the spinning top. A spinning top is like a doji with a bit of a belly. It has a small real body, but also distinct upper and lower wicks. Like the doji, it represents indecision. The buyers and sellers fought, but neither could gain much ground. The small body shows there was little difference between the open and close price. It's another signal that the current trend might be losing momentum. The previous conviction is fading, replaced by a nervous standoff. Now we move into the most critical part of single candle analysis, where context becomes everything. Here we'll see how the exact same candle shape can have two different names and two completely different meanings, all depending on where it appears in the market story. Let's talk about the hammer. A hammer is a candle with a small body at the top of the range and a long lower wick that's at least twice the size of the body. There's little to no upper wick. Imagine its story. This candle forms after a period of falling prices, a downtrend. The sellers are feeling confident. They open the session and continue to push the price down, 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 creating that long lower wick. It looks like another victory for them. But then something changes. The buyers, who have been dormant, suddenly flood the market. They see the lower prices as a bargain. They start buying with incredible force, pushing the price all the way back up to close near where it opened. The sellers tried to hammer the price down, but the buyers rejected it completely, leaving behind that long shadow of a failed attack. A hammer is a potential bullish reversal signal. It doesn't mean the downtrend is over, but it's the first sign that the bulls are waking up and fighting back. It's a candle of hope for the buyers. Now take that exact same shape, small body at the top, long lower wick, no upper wick, and place it at the top of a long uptrend. Suddenly it's not a hammer anymore. It's called a hanging man. The story is completely different. The market has been rising. The buyers are in full control. A new session opens and things look good. But during the session, the sellers suddenly show up and manage to push the price significantly lower, creating that long wick. Yes, the buyers managed to fight back and push the price to close back near the top. But the damage is done. A crack has appeared in the bullish armor. That long lower wick shows that for the first time in a while, there was significant selling pressure. The hanging man is a potential bearish reversal signal. It's a warning that the strength of the uptrend may be waning. Same shape, opposite meaning, all because of context. This powerful duality also applies to their inverted cousins. First, the inverted hammer. This candle has a small body at the bottom, a long upper wick, and little to no lower wick. It appears just like the regular hammer, at the bottom of a downtrend. What's its story? After a decline, the buyers decided to test the waters. They tried to push the price up, creating that long upper wick. But the sellers were still strong and pushed the price back down to close near the open. Now, you might think this is bearish, the buyers failed, right? But the key is that they even tried. After a long downtrend where sellers have been dominant, the mere attempt by buyers to stage a rally is significant. It shows the selling pressure might be exhausting. The inverted hammer is another potential bullish reversal signal. a sign that buyers are testing the seller's defenses. And finally, if we take that same inverted hammer shape and put it at the top of an uptrend, it becomes one of the most classic reversal patterns, the shooting star. The story here is potent. The market is in a strong uptrend. A new session opens and the buyers, full of confidence, push the price even higher, creating that long upper wick. They're reaching for the stars. But at those new heights, they are met with a wall of selling. The sellers come in with overwhelming force, rejecting the higher prices and slamming the market all the way back down to close near the open. It's a dramatic failure by the buyers. The long upper wick is a tombstone marking the high point of their failed assault. A shooting star is a strong potential bearish reversal signal. It suggests the buyers have run out of steam, and the sellers are starting to take over the battlefield. So you see, a single candle is not just a data point. It is a miniature drama. The Marubozu is a declaration of war. The doji is a tense negotiation. The hammer is a heroic last stand. And the shooting star is a tragic failed charge. Learning to read these individual candles is like learning to read the expressions on a person's face. You can tell if they are confident, scared, hesitant, or aggressive. But these single words, these individual expressions, are just the beginning. Their true power is unleashed when they start forming sentences, when they combine with the candles that come before and after them. What happens when a candle of deep indecision, a doji, is immediately followed by a massive bullish Marubozu? What story does that tell? That is where we begin to see the true narrative of the market unfold. That combination, a moment of perfect balance and profound indecision, immediately shattered by a wave of absolute conviction, tells one of the most powerful stories in trading. It's the story of a stalemate being broken. Imagine two armies evenly matched, pushing against each other with all their might. Neither side can gain an inch. That's your doji. The market is holding its breath. Then suddenly one army finds a surge of reinforcements and smashes through the enemy line, pushing them back with overwhelming force. That's your bullish Marubozu. The indecision is over. A clear victor has emerged, and the market is now charging in that direction. This is the essence of reading candlestick patterns. We are moving beyond the anatomy of a single candle and learning to read the market's body language. These patterns aren't mystical signals. They are graphical representations of mass human psychology. They are the footprints of fear, greed, and hesitation left behind by millions of traders around the world. Learning to read them is like learning to read a room. You're not just listening to the words. You're noticing the shifts in posture, the subtle nods, the sudden silences. You're understanding the sentiment behind the noise. Broadly speaking, these patterns fall into two main categories: reversal patterns and continuation patterns. Think of it like a conversation. A reversal pattern is when someone says, "Hold on, wait a minute, I'm changing my mind." It signals a potential end to the current trend. If the market was going down, a bullish reversal pattern suggests it might be about to turn and go up. If it was going up, a bearish reversal pattern suggests the party might be over. Continuation patterns, on the other hand, are like a nod of agreement. They're the market saying, "Yep, I'm still feeling good about this direction. Let's keep going." They are pauses or brief consolidations before the original trend resumes. For now, we're going to focus on some of the most classic and widely recognized reversal patterns. These are the signals that a potential U-turn is ahead. Let's start with the bulls. Imagine a market that's been in a downtrend. Prices have been falling, sentiment is negative, and the sellers or bears are in complete control. Then a specific candle appears, the hammer. The hammer has a small body at the top of the candle and a very long lower wick, at least twice the size of the body. There's little to no upper wick. The story it tells is one of a dramatic counterattack. During that trading period, the sellers continued their assault, pushing the price significantly lower, creating that long wick. It looked like another victory for the bears. But then something shifted. The buyers, the bulls who had been hiding, suddenly found a reason to fight back. They stormed into the market with incredible force, buying up everything the sellers were offering, and drove the price all the way back up to close near where it opened. The sellers tried to land a knockout blow, but the bulls caught the punch and stood back up. It's a powerful sign of rejection of lower prices and a potential bottoming of the market. It's the first glimpse of bullish strength after a long period of weakness. A close cousin to the hammer is the inverted hammer. It looks exactly like it sounds. A hammer flipped upside down. It also appears at the bottom of a downtrend, but this time it has a small body at the bottom with a long upper wick. The story here is a little different but still bullish. In this case, the buyers made the first move. They tried to push the price up, creating that long upper wick. However, the sellers were still strong enough to push the price back down to close near the open. Now, you might think that's a failure for the bulls. But think about the context. After a long downtrend where sellers have been dominant, the very fact that buyers had enough strength to even attempt such a significant rally is a signal in itself. It's like the first probe into enemy territory. It might have been repelled, but it shows the buyers are now willing to fight. It's a warning shot to the sellers that the tide may be about to turn. Now let's look at a two-candle pattern, which tells an even more compelling story. The bullish engulfing pattern. This pattern occurs when a small bearish red candle is followed by a large bullish green candle, whose body completely engulfs the body of the previous candle. The story here is one of complete and total reversal of power. On day one, the sellers are in control, even if just slightly, pushing the price down to form a small red candle. The downtrend seems to be continuing as usual. But on day two, the market opens and the buyers enter with a vengeance. They not only erase all of the previous day's losses, but they push the price significantly higher, closing well above the previous day's open. It's a total repudiation of the downtrend. The seller's control has been utterly broken and engulfed by a new wave of buying pressure. It's one of the most visually obvious and powerful signs of a potential shift from bear to bull. Of course, what goes up can also come down. For every bullish reversal pattern, there is a bearish counterpart that signals a potential top in the market. Let's look at the dark twins of the patterns we just discussed. First, the hanging man. Visually, the hanging man looks identical to a hammer. Small body at the top, long lower wick. The critical difference is its location. The hanging man appears at the top of an uptrend, and this context completely changes the story. In a strong uptrend, the buyers are in control. So when a candle forms where the sellers manage to push the price significantly lower, creating that long wick, it's a major red flag. Even though the buyers managed to push the price back up to close near the open, the damage was done. It shows that for a significant portion of that period, sellers were in control. It reveals a crack in the foundation of the uptrend. It suggests that the bullish momentum is waning, and the market is becoming vulnerable to a sell-off. Next, we have the shooting star. This is the bearish twin of the inverted hammer. It appears at the top of an uptrend and has a small body at the bottom with a long upper wick. The story is a tale of a failed assault. The buyers, full of confidence from the ongoing uptrend, tried to push prices to new highs. They charged upward, creating that long upper wick. But they hit a wall of sellers. The sellers rejected these higher prices with overwhelming force, slamming the price all the way back down to close near the open. It's a dramatic visual of the bulls being stopped dead in their tracks. It shows that every attempt to move higher was met with intense selling pressure, a clear sign that the bears are beginning to take control of the high ground. Finally, there's the bearish engulfing pattern. Just as you'd expect, it's the opposite of the bullish version. It occurs at the top of an uptrend, where a small bullish green candle is completely engulfed by the body of a subsequent large bearish red candle. The narrative is a sudden and brutal shift in sentiment. On day one, the bulls are still pushing things higher, even if momentum is slowing, as shown by the small green candle. Everything seems fine. But on day two, the bears take over in a stunning display of force. They not only wipe out all of the previous day's gains but drive the price far lower, closing well below the prior day's open. This pattern demonstrates that the bears have seized control from the bulls with absolute authority. The buying pressure has evaporated and been replaced by heavy selling. Now, this is the most important part of this entire section. A pattern is not a crystal ball. Seeing a hammer or a shooting star is not a command to immediately place a trade. These are pieces of evidence. They are clues in a larger puzzle. Two things are absolutely critical: context and confirmation. Context is everything. A bullish engulfing pattern after a massive, prolonged downtrend carries far more weight than one that appears in the middle of a choppy sideways market. The pattern's significance is directly tied to the trend that came before it. You're looking for signs of exhaustion. The reversal pattern is the signal that the dominant army is tired, and the other side is finding new strength. Confirmation is the act of waiting for more evidence. A smart trader sees a shooting star at the top of an uptrend and doesn't immediately sell. They see it as a powerful warning. They might wait for the next candle. If that next candle is also bearish, closing lower than the shooting star, that adds weight to the reversal signal. It confirms that the selling pressure is continuing. This patience, this demand for a second piece of evidence, is what separates a reactive trader from a methodical one. It helps filter out false signals and provides a higher degree of confidence in the story the chart is telling. By understanding these patterns, you're not just memorizing shapes. You are learning to interpret the ongoing battle between buyers and sellers. You're seeing the turning points, the moments of exhaustion, and the sudden surges of power. We've seen how the market signals a potential U-turn. But what about when it just wants to pause for a breath before continuing its sprint? That's the story of continuation patterns, and it's where we're going next. These patterns are the market's pit stops. They're the moments of consolidation, the brief huddles where bulls or bears regroup, catch their breath, and build up the energy to push the trend even further. A reversal pattern is a U-turn. A continuation pattern is just tapping the brakes before hitting the accelerator again. Understanding the difference is crucial, because misinterpreting a pause for a full stop can lead to exiting a potentially profitable trade way too early, or even worse, betting against a trend that's just getting started. So let's start with one of the simplest, yet most profound signs of continuation. We've already met the doji, that little cross of indecision. We saw how at the top of an uptrend or the bottom of a downtrend, it can signal a potential reversal. But what about when it appears right in the middle of a powerful charging trend? Imagine a strong uptrend, a series of long, confident green candles. Then smack in the middle, a doji appears. The open and close are nearly identical. For one brief session, the bulls and bears fought to a standstill. Now, a novice trader might see this and panic. They might think, the upward momentum is gone. The buyers are exhausted. It's time to sell. But the experienced trader sees a different story. They see a marathon runner who, after 5 miles of hard running, has slowed to a jog for 60 seconds to sip some water and check their pace. They haven't stopped running. They haven't turned around. They are simply recalibrating for the next leg of the race. That doji in the middle of a trend is often just that, a momentary pause. The market is digesting the recent move. The confirmation, as always, is the next candle. If a strong green candle appears right after that doji, closing higher, it's a powerful signal. The break is over. The bulls have had their water, and they're ready to sprint again. The indecision was temporary, and the original trend is back in control. Now let's look at the opposite of indecision. Pure, unadulterated conviction. Let's talk about the Marubozu candle in the context of continuation. Remember the Marubozu? The long, solid body with no wicks. It's a candle that screams certainty from open to close. When a green Marubozu appears during a strong uptrend, it's like adding a rocket booster to an already accelerating rocket. There is no hesitation. The buyers were in complete control from the moment the session opened to the moment it closed. It's a powerful confirmation that the sentiment driving the trend is not only intact, it's intensifying. It tells you the crowd is not just happy with the direction, they're doubling down on it. The same is true for a red Marubozu in a downtrend. It's a signal of capitulation, a sign that sellers are still firmly, and perhaps even more aggressively, in the driver's seat. But the most cinematic story of continuation is told by a 5-candle pattern. It's a mini-drama that plays out on your chart, and it's called the 3 methods formation. Let's break down the bullish version first. The rising 3 methods. Imagine the scene. Act 1. A powerful hero emerges. This is a long, strong green candle, pushing prices significantly higher within an existing uptrend. Confidence is high. The bulls are in charge and everyone can see it. The future looks bright. Act 2. The challenge. A small band of dissenters, the sellers, decides to stage a counterattack. This takes the form of 3 small red candles. They try to push the price down. One by one they appear, each closing a little lower than the last. An amateur might see this and think the tide is turning. But look closer. These 3 little candles are weak. Their entire price action, from the high of the first to the low of the last, is contained within the range of that first heroic green candle. They can't even manage to push the price below where our hero started his charge. It's a feeble rebellion, a flurry of activity that ultimately accomplishes nothing. They are operating in the shadow of the bull's power. Act 3. The resolution. Just when the sellers think they might be making some headway, the bulls return with overwhelming force. A new long green candle appears. It opens above the close of the last little red candle and soars upwards, closing at a new high, well above the top of the first hero candle. This final candle completely invalidates the entire 3-day rebellion. It's a statement. The bulls have absorbed the selling pressure without breaking a sweat, and are now continuing their march upward, stronger than before. The rising three methods pattern is a beautiful illustration of a trend's resilience. It shows not just strength, but the ability to withstand a challenge and come back even stronger. The following three methods is simply the tragic version of this story. A long, ominous red candle sets a downtrend in motion. Then, a feeble rally attempt by the bulls, represented by three small green candles that fail to break above the high of that first red candle. And finally, the crushing blow. Another long red candle that plummets to a new low, confirming the bear's absolute dominance. It's the same story of a pause, a weak challenge, and a powerful continuation. Now let's talk about something a little more dramatic: gaps. A gap is a space on your chart where no trading occurred. The price literally jumps from one level to another between the close of one candle and the open of the next. Gaps usually happen because of overnight news or a sudden shift in sentiment, causing the opening price to be significantly different from the previous day's close. And sometimes these gaps are powerful continuation signals. One classic pattern is called the Tsuki gap. Let's look at the upside Tsuki gap. The market is in a clear uptrend. Then, due to overwhelming optimism, the price gaps up at the open, forming another green candle. The bulls are ecstatic. The momentum is so strong, it's literally leaping over price levels. But then the next candle is red. It opens inside the body of the previous green candle and closes down inside the gap. This looks scary. It feels like the market is trying to reverse and fill the gap. But here is the crucial part of the story. It doesn't. The red candle closes within the gap, but it fails to close it completely. Think of it like this: you take a running leap across a wide creek. You land firmly on the other side, that's the gap up. You might stumble forward a little bit and take a small step back to regain your balance. That's the red candle. But you didn't fall back into the creek. Your forward momentum was so strong that even your stumble couldn't erase your progress. That failed attempt by the sellers to close the gap is actually a sign of underlying strength. It suggests the gap will act as a support level, and the uptrend is likely to continue. The downside Tsuki gap tells the inverse story of panic and weak hope. In a downtrend, the price gaps down, showing extreme selling pressure. Then, a small green candle attempts a rally, poking its head back up into the gap, but it doesn't have the strength to close it. The buyers are too weak. The attempt fails, and the downtrend often resumes with a vengeance. These patterns, the doji in the middle of a trend, the confirming Maribozu, the dramatic three methods, the leaping Tsuki gap, are all part of the market's vocabulary for saying, "We're not done yet." They are narratives of resilience. But like any story, context is everything. A continuation pattern is most reliable when it appears in an already established, healthy trend. Seeing one in a choppy, sideways market doesn't carry the same weight. And always look for confirmation. The story isn't over until the next candle is printed. If you see a rising three methods pattern, the story is only truly confirmed when that fifth, powerful green candle closes decisively higher. Volume is the soundtrack to this movie. High volume on those big, decisive candles, the first and fifth candles in the three methods for instance, is like the roar of the crowd, adding immense credibility to the move. It tells you that a lot of market participants are backing this direction. We've now learned to read individual letters like the doji. We've learned to read short, two-candle sentences of reversal. And now we're reading multi-candle paragraphs that tell us the story is set to continue. We've learned to see the pauses, the challenges, and the ultimate reaffirmation of a trend's power. But what happens when we zoom out even further? What happens when dozens or even hundreds of these candles start to form bigger, more complex shapes on our charts? Shapes that tell epic stories of pressure building over weeks or months, coiling like a spring until it reaches a breaking point. These are the classic chart patterns: the triangles, the flags, the head and shoulders. We've been learning the words and sentences of the market's language. Next, we're going to start reading the full chapters. These patterns are the grand narratives, the plots and subplots that play out over days, weeks, or even months. They are formations created by dozens or hundreds of individual candlesticks, all coming together to tell a larger story about the epic struggle between buyers and sellers. And just like in literature, these market stories tend to fall into two major categories: stories of reversal and stories of continuation. Let's start with the most dramatic plot twists, the reversal patterns. These are the patterns that can signal a potential end to the current trend. Imagine a character in a movie who has been on a winning streak for the entire first act. A reversal pattern is the moment something fundamental shifts, the moment our hero stumbles, and the story changes direction. The most classic, the most talked about reversal pattern is the head and shoulders. Think of it as the story of a king's failed attempt to conquer new territory. First, you have an established uptrend. The king is marching his army up the hill, prices are making higher highs and higher lows. Then we get the left shoulder. This is a strong peak, a new high followed by a minor pullback. The bulls are still in control, just taking a breather. Next comes the head. This is where the king makes his big push. The price rallies even higher than the left shoulder, reaching a climactic peak. This is the moment of maximum optimism. Everyone thinks the trend will go on forever, but then it fails. The price falls back down, usually to around the same level as the previous low after the left shoulder. This is a critical moment. The king's grand assault has been repelled. Finally, we get the right shoulder. The bulls, the king's loyal soldiers, try one last time to rally. They push the price up again, but this time they run out of steam. They can't even reach the height of the previous peak, the head. Their energy is fading. This failure to make a new high is a massive red flag. It shows the buying pressure is exhausted. Now, if you connect the lows of the two pullbacks, the one after the left shoulder and the one after the head, you get a line. This is called the neckline. The neckline is the last line of defense for the bulls. It represents the support level that has been holding the price up. The story of the head and shoulders reaches its climax when the price breaks below this neckline. This breakdown is often seen as a confirmation that the uptrend has lost its momentum, and a new downtrend could be starting. The king has not only failed his assault but has been forced into a full retreat from his own castle. Of course, every hero has an evil twin, and the head and shoulders is no exception. Its opposite is the inverse head and shoulders. It's the exact same story but flipped upside down, telling a tale of a potential bottom and a reversal from a downtrend to an uptrend. It's the story of an underdog rising. You have a downtrend, a low, the left shoulder, a lower low, the head, and then a higher low, the right shoulder. The neckline connects the highs of the bounces. A break above this neckline suggests the sellers have run out of ammunition, and the buyers are finally staging a successful counterattack. Two other powerful, yet simpler reversal stories are the double top and the double bottom. Think of a double top as the impenetrable ceiling story. The price is in an uptrend, it hits a certain level of resistance and gets rejected. It falls back, regroups, and the buyers charge at that same ceiling again with all their might, only to be rejected a second time at almost the exact same price level. This second failure is psychologically devastating for the bulls. It proves that the sellers at that price are a formidable force. It's like trying to break down a wall, failing, and then trying again only to find the wall has been reinforced with steel. A break below the low point between the two tops is often interpreted as the signal that the trend may be reversing. The double bottom is the unbreakable floor story. In a downtrend, the price hits a support level and bounces. The sellers push it back down for another attempt, but it finds support at that same level again and bounces. This shows that buyers are stepping in at that price, creating a solid foundation. It's a sign that the selling pressure is being absorbed, and the downtrend might be exhausted. Now, not every story has a dramatic plot twist. Sometimes, the story just pauses for a moment of reflection before continuing on its path. These are the continuation patterns. They are periods of consolidation, where the market takes a breath before potentially resuming its original trend. The most common continuation patterns are the triangles. Imagine a spring being coiled tighter and tighter. That's the energy a triangle represents. There are three main types. First, the symmetrical triangle. This is a story of pure indecision. After a move up or down, the price starts making lower highs and higher lows. The trading range gets narrower and narrower, squeezing the price into the apex of the triangle. Buyers and sellers are in a temporary equilibrium, neither one having a clear advantage. The tension builds and builds until the price is forced to break out. While it can break in either direction, analysts often look for the breakout to occur in the same direction as the trend that led into the triangle. Second, we have the ascending triangle. This is a story of bullish persistence. You have a flat, horizontal resistance line at the top, a clear line of sellers defending their position. But from below, the buyers are relentless. They keep pushing the price up, and each time they get knocked back, they don't retreat as far. They are making a series of higher lows. This pattern suggests that the buyers are gradually gaining strength and wearing down the sellers. It's like an army laying siege to a castle, getting pushed back each time, but setting up their camp a little closer to the walls after every attempt. A breakout above that flat top resistance is the potential signal that the castle walls have been breached, and the uptrend is ready to resume. The opposite is the descending triangle, a story of bearish pressure. Here you have a flat support line at the bottom with buyers desperately trying to hold the line. But the sellers are applying constant pressure from above, creating a series of lower highs. Each rally is weaker than the last. This suggests the sellers are in control, and the buyers' defenses are about to crumble. A break below that flat support level can indicate that the downtrend is likely to continue. Finally, we have the quickest stories in the market library. Flags and pennants. These are short-term continuation patterns that look exactly like their names. They happen after a very sharp, almost vertical price move, which forms the flagpole. Following this explosive move, the market needs to catch its breath. It enters a brief period of consolidation. If this consolidation is a small rectangular channel that slopes against the flagpole, it's a flag. If it's a tiny symmetrical triangle, it's a pennant. These patterns are important because they often represent a brief pause in a powerful trend, not a reversal. It's the market digesting a big gain or loss before making its next move, which is often another explosive push in the same direction as the flagpole. Understanding these patterns, the head and shoulders, the triangles, the flags, is like learning to recognize the recurring plot devices in your favorite genre. You start to see the narrative structure of the market. You're no longer just looking at a chaotic series of up and down ticks. You're seeing stories unfold. You're seeing the psychology of the crowd play out in real time. The hope, the fear, the exhaustion, and the exuberance all drawn onto a chart. But here's the critical thing to remember. A pattern is not a prophecy. It's a suggestion. It's a high probability setup based on historical behavior, not a crystal ball. Pattern can fail. A perfect ascending triangle can break to the downside. A textbook head and shoulders can suddenly reverse and scream to new highs. Recognizing the shape is only the first step. The real art and science come from knowing how to validate these patterns, how to tell a genuine story from a false rumor. And that requires looking for more evidence for confirmation. It requires understanding the supporting characters in our story, like volume, and knowing how to avoid the market's favorite trick, the false breakout. So let's talk about these supporting characters, starting with the most honest one in the room: volume. Think of volume as the market's truth serum. A candlestick pattern tells you what happened with price, but volume tells you how many people cared. It's the difference between one person whispering a rumor and an entire stadium roaring a fact. In Forex, we typically look at tick volume, which measures the number of price changes or ticks within a candle. While it's not the same as share volume in stocks, it serves as a powerful proxy for market participation and conviction. Imagine you see a massive, beautiful bullish engulfing candle form right at a key support level. Price action alone is screaming buy. It's a powerful signal. But then you look down at the volume indicator, and you see that this huge green candle formed on a tiny pathetic sliver of volume, far below the recent average. What does that tell you? It tells you that while the price moved a lot, very few traders were actually involved in that move. It was a shout in an empty room. There's no broad consensus, no powerful conviction behind it. This is a massive red flag. It suggests the move might be weak, easily reversible, and potentially a trap. Now, flip that scenario. You see the exact same bullish engulfing candle at the same support level. But this time, you glance down and see a colossal spike in volume. The volume bar is the tallest it's been in 50 candles. This is the stadium roar. This tells you that a huge number of market participants jumped in, aggressively buying and overwhelming the sellers. This is confirmation. This is the market putting its money where its mouth is, validating the story the candlestick is trying to tell. High volume confirms strength. Low volume questions it. This principle applies to reversals, continuations, and everything in between. A breakout above a key resistance level on massive volume? That suggests a genuine shift in sentiment. A breakout on dwindling pathetic volume? That's the market testing the water, and it's a prime candidate for failure. This brings us directly to the market's favorite magic trick, its most common and frustrating illusion: the false breakout. A false breakout, or a fake out, is a move that every trader has fallen for. It's when the price punches decisively through a key level of support or resistance, triggering a flood of entries from breakout traders, only to then violently reverse and trap them all. It's a brutal, costly lesson in patience and confirmation. The market dangles the carrot of a new trend, and just when everyone bites, it snatches it away and smacks them with the stick. So how do we use our new understanding of candlesticks and volume to avoid this trap? The first clue, as we just discussed, is volume. A true breakout, a move that is likely to sustain itself, is typically accompanied by a significant increase in volume. It's the fuel for the rocket. A breakout that occurs on low or declining volume is like a rocket trying to launch with an almost empty tank. It might lift off the pad a few feet, but it's very likely to come crashing back down. When you see price breaking a key level but the volume isn't there to support it, you should be on high alert. Your skepticism should be dialed up to 11. The second clue is the candle's close. This is critical. A lot of false breakouts happen intra-candle. The price might spike above resistance for a few minutes, triggering all the buy orders, but by the time the candle actually closes, whether it's a 1 hour, 4 hour, or daily candle, the price has retreated back below that level. This often leaves behind a candlestick with a long upper wick, like a shooting star or a pin bar. That long wick is the tombstone of all the traders who jumped in too early. It's a visual story of a failed attack. This is why many experienced traders wait for a candle to close above a key level before considering a trade. They need that final confirmation that the buyers or sellers have actually won the battle for that period, not just for a fleeting moment. Let's build a more complete picture. You see the price approaching a major resistance level that has held for weeks. The market is tense. Then a candle pushes through it. FOMO, the fear of missing out, starts screaming in your ear. But you wait. You look at the volume. It's weak. That's warning sign number 1. Then you wait for the candle to close. As the final seconds of the hour tick by, the price gets slammed back down, closing below the resistance level and leaving a nasty-looking wick. That's warning sign number 2. You've just witnessed a classic false breakout, and by demanding more evidence, by looking for confirmation, you've saved yourself from a losing trade. But there's one more layer to this, one more powerful tool for confirmation that separates the amateur from the professional. It's the ability to see the forest for the trees by using multiple time frame analysis. Think about it this way. Looking at a single time frame like a 15-minute chart is like reading a single page of a book. You might understand what's happening on that page, but you have no idea about the overall plot, the character arcs, or the story's direction. To get the full context, you need to zoom out and read the entire chapter or even the whole book. This is what multiple time frame analysis does. The higher time frames, like the daily or the weekly charts, tell you the main story, the dominant long-term trend. The lower time frames, like the 1 hour or 15-minute charts, show you the subplots and the scene-by-scene action. Here's a common scenario that traps traders. A trader is looking at a 1-hour chart and sees a perfect bullish engulfing pattern forming at a support level. It's got good volume, it's a textbook signal. Based on this one chart, it looks like a fantastic buying opportunity. But what this trader fails to do is zoom out. If they had just clicked over to the daily chart, they would have seen that this support level on the 1-hour chart was happening right underneath a massive multi-month resistance level on the daily chart. They would have seen that the dominant, overwhelming trend was bearish. So what they thought was the start of a new uptrend was actually just a minor bounce. A small wave pushing up against a giant tsunami of selling pressure. Their beautiful 1-hour signal was destined to fail because it was fighting the bigger, more powerful trend. Trading without considering the higher time frame context is like trying to paddle a canoe against a powerful river current. You might make a little progress here and there, but the dominant force is working against you, and it's exhausting and incredibly risky. A more robust approach is to use the higher time frames to establish a directional bias, and then use the lower time frames to find precise entry points. For example, you look at the daily chart and see a clear, strong uptrend. The tide is coming in. Now you zoom into the 4-hour or 1-hour chart to look for buy signals. You wait for the price to pull back to a support level, and then form a bullish candlestick pattern, like a hammer or a bullish engulfing. Now your signal is aligned with the dominant trend. You're not fighting the current. You're using it to propel you forward. This alignment of signals across multiple time frames is one of the most powerful forms of confirmation a trader can find. So we've now added 3 critical layers to our analysis. We're not just looking at a single candle in a vacuum anymore. We're asking deeper questions. We see a pattern and we ask, does the volume confirm the conviction behind this move? Did the candle actually close in a position of strength? Or is that long wick telling me a story of failure? And finally, how does this small story on my current chart fit into the epic novel being told on the higher time frames? By combining candlestick patterns with an analysis of volume, the candle's close, and the perspective of multiple time frames, you transform yourself from a simple pattern spotter into a market detective. You're gathering clues, looking for evidence, and building a comprehensive case before you ever risk a single dollar. You're learning to distinguish between a high-probability setup and a well-disguised market trap. But even with these tools, we're still looking at relatively small-scale formations. What happens when these individual candles start to band together over time to form much larger, more significant structures? What happens when the market story evolves from short sentences into entire paragraphs of intention? That's when we start to see the emergence of classic chart patterns. These patterns are the visual history of a battle between buyers and sellers, drawn right on your screen. They show you periods of intense conflict, moments of exhaustion, and times of quiet consolidation before the next major campaign begins. Understanding them is like learning to read the strategic map of the market. It's a shift from seeing random noise to recognizing the telltale formations of an army gathering its strength or preparing for a retreat. Fundamentally, chart patterns fall into two major categories: reversal patterns and continuation patterns. It's as simple as it sounds. Reversal patterns suggest that the current trend is running out of steam and might be about to change direction. Continuation patterns, on the other hand, suggest the market is just taking a breather before continuing on its original path. Let's start with the heavy hitters, the reversal patterns that can signal a major turning point. Perhaps the most famous of all is the head and shoulders pattern. It sounds a bit strange, but its shape is incredibly descriptive of the psychology behind a dying uptrend. Imagine a market that's been climbing steadily. The bulls are in full control. They push the price up to a new peak. This forms the left shoulder. After this peak, there's a small pullback as some traders take profits. But the overall optimism is still high, so buyers rush back in with even more force, pushing the price to an even higher peak. This is the head. This is the moment of maximum optimism, the point where it feels like the price will go up forever. But then something changes. The price falls from the head, back down to a similar level as the previous pullback. This level of support, which connects the lows of the two pullbacks, is what we call the neckline. It's the line in the sand. Now the bulls try one more time to rally. They push the price up again, but this time they lack the conviction, the energy they had before. They failed to reach the height of the head. This weaker peak forms the right shoulder. This failure is a huge psychological red flag. The market just showed it no longer has the strength to make new highs. The optimism is fading, replaced by doubt. The final act is when the price falls from the right shoulder and breaks decisively below that neckline. That break is often seen as the confirmation. It's the market signaling that the bulls have lost control, and the bears are now in charge. The uptrend, for all intents and purposes, is considered to be over, and a new downtrend may be starting. And of course, this pattern has a mirror image: the inverse head and shoulders. It's the exact same story, but flipped upside down at the bottom of a downtrend, signaling a potential shift from selling pressure to buying pressure. Another powerful pair of reversal patterns are double tops and double bottoms. They are simpler than the head and shoulders, but they tell a very similar story of exhaustion. A double top looks like the letter M. The price rallies up to a peak, hits a level of resistance and pulls back. Then, the buyers try again to push through that same resistance level. They rally back up to that same peak, but they fail. They get rejected a second time. Think of it like trying to break through a solid wall. The first hit shows you where the wall is. The second failed attempt shows you the wall is strong, and a lot of the force trying to break it has been spent. That second rejection is a powerful sign that the buying pressure is drying up. Sellers are defending that price level, and the buyers just don't have the momentum to overcome them. A break below the low point between the two peaks is often interpreted as confirmation that the trend may be reversing downwards. A double bottom, naturally, is the opposite. It looks like a W at the end of a downtrend and suggests that a key support level has held twice, potentially signaling the end of the selling and the beginning of a new rally. Now, what about when the market isn't reversing but just pausing? That's where continuation patterns come in. These are periods of consolidation within a larger trend. The market is like a long-distance runner. It can't just sprint forever. It needs to slow down, catch its breath, and then continue the race. One of the most common continuation patterns is the triangle. There are three main types. First, the symmetrical triangle. This is formed when the highs of the price action are getting lower, and the lows are getting higher. The price is being squeezed into a tighter and tighter range from both sides. This represents pure indecision in the market. Neither the buyers nor the sellers can gain the upper hand. The market is coiling up like a spring building energy. Typically, the expectation is that when the price finally breaks out of this triangle, it will continue in the direction of the original trend that led into it. Then you have the ascending triangle. In this pattern, you see a flat level of resistance at the top, a price ceiling the market keeps hitting, but the lows are getting progressively higher. This tells a specific story. The sellers are holding a firm line at that resistance level, but the buyers are getting more and more aggressive. They are stepping in to buy at higher and higher prices each time there's a dip. This increasing buying pressure against a static selling wall often suggests a potential breakout to the upside. The opposite is the descending triangle. Here you have a flat support level at the bottom, but the highs are getting progressively lower. The buyers are defending that support level, but the sellers are getting more aggressive, willing to sell at lower and lower prices on each rally. This pattern of increasing selling pressure often suggests a potential breakdown below the support level, continuing the downtrend. Finally, let's talk about some of the fastest moving continuation patterns: flags and pennants. These patterns usually appear after a very sharp, almost vertical price move, which looks like a flagpole. Following this explosive move, the price will consolidate sideways in a tight range. If that range is a small rectangular channel that slopes slightly against the main trend, it's called a flag. If it's a tiny symmetrical triangle, it's called a pennant. What these patterns represent is a brief pause. After a huge price surge, some traders cash in their profits, causing a small, orderly pullback. But new traders, seeing the strong trend, are waiting to jump in. This quick period of consolidation allows the market to digest the big move before the original trend often resumes with another burst of energy. Flags and pennants are short-term patterns that suggest the market is just refueling before the next leg of its journey. Now, here is the most important thing to remember about every single pattern we've discussed. They are not crystal balls. They are tools for analyzing probabilities, not for predicting certainties. A head and shoulders pattern doesn't guarantee a reversal. It simply highlights a situation where, historically, a reversal has become more likely. Patterns can fail. A triangle can break out in the opposite direction. A double top can suddenly be smashed through on the third attempt. This is why context is king. A chart pattern doesn't exist in a vacuum. Its significance depends on the larger trend, the volume during its formation, and how it lines up with other pieces of market information. These patterns are the paragraphs, but they are just one part of a much larger book. So how do we start to read that entire book? How do we combine these psychological shapes with mathematical tools to get an even clearer picture of the market story? That's where we bring in the power of technical indicators. Think of technical indicators not as a crystal ball, but as a set of specialized lenses. If candlesticks are the words and patterns are the sentences, indicators are the tools we use to analyze the grammar, syntax, and subtext of the market story. They help us quantify the psychology we've been observing. They take the raw emotion captured in the candles and translate it into objective mathematical data. They don't predict the future, but they can provide incredible clarity on the present and the immediate past, helping us to filter out the noise and focus on what truly matters: trend, momentum, and volatility. Let's start with one of the most fundamental and widely used indicators: the moving average. Imagine you're tracking the temperature every single day. One day it's 75 degrees, the next it's 68, the next it's 78. It's noisy. It's hard to tell if it's getting warmer or colder overall. But if you take the average temperature over the last 30 days, you get a much smoother, clearer picture of the season. That's exactly what a moving average does for price. It takes the average closing price over a set number of periods, say 20 candles, 50 candles, or 200 candles, and plots it as a single flowing line on your chart. It smooths out the day-to-day volatility, the random spikes and dips, to reveal the underlying trend. There are two main types you'll encounter: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA is straightforward democracy. Every price in the period gets an equal vote. The 50-period SMA simply adds up the last 50 closing prices and divides by 50. The EMA is more like a weighted system. It gives more importance or weight to the most recent prices. This makes the EMA react more quickly to new price changes, hugging the candles a bit more closely. One isn't inherently better than the other. They just tell slightly different versions of the same story. The SMA gives you a broad, stable view of the trend, while the EMA gives you a more responsive, up-to-the-minute feel. So how do we use this line to read the market story? First, for basic trend identification, is the price generally trading above the moving average? That suggests a potential uptrend. Is it trading below? That points to a potential downtrend. Is the moving average line itself sloping upwards or downwards? This gives you the general direction of the market's current. Second, traders often observe that moving averages can act as dynamic levels of support and resistance. In a strong uptrend, you might notice the price pulling back to a 50-period EMA and then bouncing off it as if it were a floor. This shows that buyers are consistently stepping in at that average price, defending the trend. The opposite can be observed in a downtrend, with the line acting as a ceiling. Finally, traders watch for crossovers. This is when a shorter-term moving average like a 20-period EMA crosses over a longer-term one, like a 50-period EMA. When the fast line crosses above the slow line, it suggests that recent momentum is becoming more bullish than the longer-term trend, a potential signal that a new uptrend could be forming. Conversely, when the fast line crosses below the slow line, it's a sign that recent momentum is turning bearish. These aren't magic signals, but they are significant events in the chart's narrative, a potential changing of the guard from buyers to sellers, or vice versa. Now, if the moving average tells us about the direction of the trend, our next indicator tells us about its strength or energy. This is the Relative Strength Index, or RSI. The RSI is what's known as a momentum oscillator. It doesn't measure the absolute price level. It measures the speed and change of price movements. Think of it like the tachometer on a car. The speedometer tells you how fast you're going, that's the price. The tachometer tells you how hard the engine is working, that's the RSI. It's measured on a scale from 0 to 100. Traditionally, a reading above 70 is considered overbought, and a reading below 30 is considered oversold. But these terms can be misleading. Overbought doesn't automatically mean sell, and oversold doesn't mean buy. A market can stay overbought for a very long time in a powerful uptrend. What it really means is that the engine is running hot. The upward momentum is strong, but potentially stretched. It's a warning light suggesting the trend might be running out of steam and could be due for a pullback or a period of consolidation. It's a measure of exhaustion. The most powerful way to use the RSI, however, is to look for divergence. This is when the indicator tells a different story than the price chart. Imagine the price makes a new higher high, but at the same time the RSI makes a lower high. This is called bearish divergence. The price is screaming we're going higher, but the underlying momentum, the engine's power, is actually weakening. It's a major crack in the narrative. It's a clue that the conviction behind the move is fading, and a reversal could be on the horizon. The same is true in reverse. If the price makes a new lower low, but the RSI makes a higher low, that's bullish divergence. It suggests that even though sellers are pushing the price down, their momentum is fizzling out. So we have a tool for trend direction, the moving average, and a tool for momentum, the RSI. What if we could combine them? That's essentially what our third indicator does. It's called the Moving Average Convergence Divergence, or MACD. It sounds complicated, but the concept is brilliant. It's a trend-following momentum indicator that shows the relationship between two exponential moving averages. The MACD has three main components. First, the MACD line itself, which is calculated by subtracting the 26-period EMA from the 12-period EMA. This essentially measures the distance between a faster and a slower moving average. When the fast EMA pulls away from the slow EMA, the MACD line rises, indicating increasing upward momentum. When they get closer, it falls. Second, there's the signal line, which is a 9-period EMA of the MACD line. It's a moving average of a moving average, which acts to smooth out the MACD line and make it easier to interpret. Finally, there's the histogram. This is the visual representation of the distance between the MACD line and its signal line. When the histogram bars are tall, it means momentum is strong and accelerating. When they start to shrink, it means momentum is slowing down. Traders use the MACD in a few key ways. The most common is the crossover. When the MACD line crosses above the signal line, it's seen as a potential shift to bullish momentum. When it crosses below, it's a potential shift to bearish momentum. Another key event is the centerline crossover. When the MACD line itself crosses above the zero line, it signifies that the shorter-term average has crossed above the longer-term average, a broader confirmation of a potential uptrend. And just like the RSI, the MACD is incredibly powerful for spotting divergence. If price is making higher highs but the max histogram is making lower highs, it's that same classic story. The outward price action is not supported by the underlying momentum. Now, here is the most important rule when using any indicator. They are all lagging. They are built using past price data. They don't predict, they confirm. They are rearview mirrors, not crystal balls. Using any single indicator in isolation is like trying to navigate a city with just a compass. You know which way is north, but you have no idea about the streets, the traffic, or the dead ends. The true art and science of technical analysis lies in finding confluence. Confluence is when multiple independent tools all point to the same conclusion. Imagine a scenario. You see a powerful bullish engulfing pattern form right at a historical support level. That's your candlestick story. You look below the chart, and you see that the price also just bounced perfectly off the 200-period moving average. That's your trend confirmation. At the same time, you notice the RSI is showing bullish divergence, having made a higher low while the price made an equal low. That's your momentum confirmation. Now you have 3 different analytical tools: price action, trend, and momentum, all telling you the exact same story. Buyers are stepping in with conviction at a critical level. This confluence creates a much higher probability setup than any single signal ever could. It's the difference between a single witness and a chorus of voices all shouting the same thing. These indicators give us a framework, a way to structure our analysis of the raw price action. They help us understand the context of the story the candlesticks are telling. But there's one more critical piece of the puzzle. We've talked about the words and the analysis tools, but we haven't talked about the structure of the book itself, the key chapters, the plot twists, the recurring themes. In trading, these are the levels of support and resistance, the very architecture of the market. How do we identify these critical zones where the biggest battles between buyers and sellers are fought? It starts with a simple observation, one that even a child playing with a ball understands. When you drop a ball, it hits the floor and bounces. If you throw it up, it hits the ceiling and comes back down. The market, in its own chaotic way, behaves in a remarkably similar fashion. These floors and ceilings are the levels of support and resistance. They are not random lines drawn on a chart. They are the collective memory of the market, etched into the price action. They are zones of immense psychological gravity where the narrative of the market is decided. Let's start with the floor support. A support level is a price point on a chart where buying pressure is historically strong enough to overcome selling pressure, causing the price to stop falling and bounce back up. Think of it as a wholesale price level. As the price drops and approaches this level, buyers who were waiting on the sidelines see an opportunity. They think, this is a bargain. This is a fair price. They start to enter the market, creating a wave of demand. At the same time, sellers who were pushing the price down start to have second thoughts. They see the price stalling, they see the buyers stepping in, and they begin to take their profits, closing their sell positions. This combination, new buyers entering and old sellers exiting, creates a powerful floor, a zone where the downtrend is arrested and often reversed. The more times a price level has acted as a floor in the past, the more market participants will be watching it, and the stronger that support level becomes. It's a self-fulfilling prophecy, built on the foundation of shared market psychology. Now let's look at the ceiling: resistance. Resistance is the mirror image of support. It's a price level where selling pressure historically overcomes buying pressure, causing an uptrend to stall and reverse. This is the retail price level. As the price rallies towards this ceiling, buyers who rode the wave up start to think, this is a great place to take my profits. They begin to sell. Simultaneously, sellers who believe the asset is now overvalued see their chance to enter the market. They see the price hitting a historical barrier and decide it's a prime opportunity to go short. This double whammy of profit-taking from buyers and fresh selling from bears creates a formidable ceiling. Just like support, the more times a price has been rejected from a resistance level, the more significant it becomes. It's a line in the sand drawn by the collective agreement of sellers that, for now, the price shall not pass. So, how do we find these invisible battle lines on our charts? It's less about pinpoint precision and more about identifying zones of confluence. You start by zooming out. Look at a higher time frame chart like a daily or a 4-hour chart to get the big picture. Scan the chart for obvious turning points, the peaks and valleys in the price history. To identify a potential support level, look for at least 2 or 3 significant lows that line up at roughly the same price. Connect these dots. To find resistance, do the opposite. Look for 2 or 3 significant highs that top out at a similar price level and connect them. But here's a critical distinction that separates novices from seasoned analysts. Support and resistance are not laser-thin lines. They are zones. They are areas. Price will rarely touch your line to the exact pip and reverse. The market is messy. It will often pierce through the line slightly or turn just before it, testing the conviction of traders. That's why it's often more effective to draw these levels as narrow rectangles or thick bands on your chart, encompassing the cluster of wicks and bodies at those turning points. This acknowledges the noise and helps you avoid getting shaken out of a position by a minor overshoot. The strength of a zone is determined by three factors: the number of times it has been tested, the duration it has held in the past, and the volume of trading that occurred at that level. A level that has held back price for months and on multiple occasions is vastly more significant than one that formed on a 15-minute chart an hour ago. Now, here's where the story gets truly interesting. What happens when these seemingly unbreakable barriers break? This is one of the most powerful dynamics in technical analysis, a concept known as the role reversal. When a strong support level is decisively broken, it doesn't just disappear. It flips its identity. That floor becomes the new ceiling. Think of it like a battle for a fortress. For weeks, the buyers have defended the fortress walls at a certain price. But one day, the sellers mount an overwhelming attack and breach the walls. They conquered the fortress. Now, where do you think they will set up their new line of defense? On those very same walls. The old support level, now that price is below it, becomes a new and powerful resistance level. Buyers who bought at the old support are now trapped in losing positions, and if the price rallies back to their entry point, they are often desperate to sell and get out at break-even, adding to the selling pressure at that new resistance. The same is true in reverse. When a stubborn resistance level is finally broken, the ceiling becomes the new floor. The sellers who were defending that level have been overrun. Buyers are now in control. If the price pulls back to that old resistance level, it is now seen as a new area of opportunity, a new support zone where buyers are likely to step in and defend their newly conquered territory. This principle of support turning into resistance, and resistance turning into support, is a cornerstone of reading market structure. It shows you how the balance of power is shifting, and provides a roadmap of potential future turning points. This is where everything we've learned comes together. The candlesticks are the characters, telling us the story of the battle in real time. The support and resistance zones are the setting, the critical locations where these battles take place. A candlestick pattern doesn't exist in a vacuum. Its significance is magnified tenfold by its location. Imagine you see a powerful bullish engulfing pattern, a clear sign of buying pressure. If that pattern appears in the middle of a random price swing, it's interesting. But if that same bullish engulfing pattern appears right on top of a major, multi-touch support level on a daily chart, it's not just interesting. It's a profound statement. It's the market screaming that the buyers are making a stand at a historically significant location. Conversely, think about seeing a shooting star, with its long upper wick showing a rejection of higher prices. If you see it randomly, it's a minor clue. But if that shooting star forms precisely at a long-standing resistance level that has rejected price 3 times before, it's a powerful signal. It's the market telling you that the sellers are defending their fortress with everything they've got. By combining the story of the individual candlesticks with the context of the market's architecture, these support and resistance zones, you move from simply reading patterns to understanding the narrative. You can see the ebb and flow of supply and demand, identify high-probability turning points, and begin to anticipate the market's next move with far greater clarity. We now have the characters, the individual candlestick soldiers and their formations. We have the battlefield, the critical zones of support and resistance where the market's fate is decided. We understand the plot twists, like when a conquered floor becomes a new ceiling. But having all the pieces on the board is one thing, knowing how to play the game is another entirely. How do you synthesize all this information into a coherent framework for making decisions? How do you manage the inherent risks and, more importantly, how do you manage the one variable that can sabotage even the best analysis, yourself? That is the final and perhaps most crucial piece of this entire puzzle. It's a battle fought not on the charts, but in the 6 inches between your ears. You can learn to identify every candlestick pattern, draw every trend line with perfect precision, and calculate Fibonacci levels to the decimal point. But if you can't control your own emotional responses, none of it matters. The market is a master at exposing our deepest flaws. Our impatience, our fear, our greed, and our need to be right. A trader's greatest enemy isn't a sudden market crash or a spike in volatility. It's the person staring back at them in the reflection of their monitor. This is the domain of trading psychology. It's the understanding that you are not paid to be an analyst. You are paid to be a risk manager and an execution specialist. Your analysis might tell you that a bullish engulfing pattern at a major support level is a high probability setup. But what happens when you enter the trade and it immediately moves against you? Fear kicks in. The voice in your head screams, "Get out now. Save what you can." You close the trade for a small loss. only to watch it reverse and rocket towards your original profit target without you. Or consider the opposite. You catch a great move. The trade is deep in profit. Your analysis says to take your gains at the next resistance level. But greed whispers, just a little more. This could be the big one. You hold on, ignoring your plan. The market turns and you watch your hard-won profit evaporate, sometimes even turning into a loss. This emotional roller coaster is what wipes out most aspiring traders, not a lack of knowledge about candlestick patterns. The solution is to build a system, a fortress of logic and rules that protects you from yourself. This fortress is built on two foundational pillars: ironclad risk management and a detailed trading plan. Let's start with risk management. This is the most important topic we will ever discuss. It is the art of staying in the game. The number one job of a trader is not to make money. It's to protect the capital they already have. The first tool in your risk management toolkit is the stop-loss order. A stop-loss is a predetermined price at which you will exit a trade if it moves against you. It is your non-negotiable line in the sand. It's not a sign of failure. It's a calculated business expense. Before you even click the buy or sell button, you must know exactly where you will get out if you're wrong. Without a stop-loss, you are not trading. You are gambling with hope as your only strategy. The second tool is position sizing. This determines how much of your account you will risk on any single trade. Many seasoned traders suggest risking no more than 1 or 2% of their total account capital on one idea. Let's make that real. If you have a $10,000 account, a 1% risk is $100. This means that if your stop-loss gets hit, you lose $100 and nothing more. This is powerful for two reasons. First, it's mathematically sound. You could be wrong 10 times in a row and still have 90% of your capital left to trade. It prevents the catastrophic loss that ends a trading career. Second, and just as important, it keeps the emotional stakes low. When you know that the absolute most you can lose is a small, manageable amount, you're less likely to make fear-based decisions. You can let the trade play out according to your plan because the outcome of this one trade doesn't define you. The final piece of risk management is the risk-to-reward ratio. Before entering a trade, you must ask, is the potential profit worth the risk I'm taking? A common benchmark traders aim for is at least a 1-to-2 or 1-to-3 risk-to-reward ratio. This means for every $1 you are risking, you are aiming to make at least $2 or $3. Think about the implications. If you have a 1-to-3 risk-to-reward ratio, you only need to be right 33% of the time to break even before commissions and fees. If you can be right just 40% of the time, your account has the potential to grow. This framework shifts your focus from needing to be right all the time to simply finding good setups where the potential reward heavily outweighs the initial risk. Now, how do you tie all this together? With the second pillar, your trading plan. A trading plan is your personal business plan for navigating the markets. It is a set of rules that you create for yourself, in a calm and objective state of mind, away from the live market. This document dictates every action you take. It should be so specific that it removes all ambiguity and emotion from your decision-making. What goes into a trading plan? Starts with your setup. What specific candlestick pattern or combination of factors are you looking for? For example, I will only look for trades based on a clear hammer or shooting star pattern that forms at a pre-identified daily support or resistance level. Next, your entry criteria. I will enter the trade 5 minutes after the qualifying candle closes, placing a market order. Then your exit criteria for a loss. My stop loss will be placed 10 pips below the low of the hammer, or 10 pips above the high of the shooting star. And finally, your exit criteria for a profit. My profit target will be set at the next opposing support or resistance level, ensuring a minimum 1-to-2 risk-to-reward ratio. This is your constitution. When the market is open and prices are flying, you don't think, you don't feel, you don't guess. You look at your plan and you execute. Is there a valid setup according to your rules? If yes, you take the trade. If no, you do nothing, even if you feel the itch of FOMO, the fear of missing out. This is how you transform from a gambler into a systematic trader. The candlestick patterns we've spent all this time learning are just one component of this plan. They are the signal, the potential opportunity. But your trading plan is the system that validates whether that signal is worth acting on. So we've come full circle. We started with a single candle, a simple representation of price over time. We learned how to read its story, the story of the battle between buyers and sellers. We combined candles to form patterns, powerful narratives of potential reversals and continuations. We put them into the context of the wider market structure, using support, resistance, and trend lines to understand the landscape. But the final lesson is this: reading the chart is only half the battle. The other half is reading yourself. The goal is not to predict the future. No one can. The goal is to build a process, a methodology that gives you a statistical edge over a large series of trades. It's about having the discipline to follow your plan when you're scared, the humility to stick to your stop loss when you're wrong, and the patience to wait for the high-quality setups that your plan defines. This journey is a marathon. It requires continuous learning, rigorous self-analysis, and an unwavering commitment to your process. Start with a demo account. Practice identifying patterns. Formulate a trading plan. Test it. Refine it. Treat it like you would training for any elite profession. The candlestick chart is your map, but discipline is the compass that will guide you. The story of price is written one candle at a time, and the story of your trading career will be written one disciplined decision at a time.